right in. I'm Cameron Massey. This is CVS Health. Let's start off with a recommendation. I set a hold on CVS. The stock has potential upside right now of about 1%, but I think it has strong potential value in the future. My thesis is based on company-wide growth and the fact that their investments are beating market expectations. And I use an average between my DCF and discounted growth model to value the stock at about 82 per share. It's currently trading at about 81. Some of the risks include liquidity concerns, reimbursement pressures, and mail order competition. But some of the catalysts include Medicare Advantage growth, vaccine distributions, and debt repayment. And we're going to jump right into those. So going over the company as a whole, a recent transaction for the company was Aetna, purchased in 2018. They have a consumer base of about 39 million, and CVS used them to vertically integrate insurance into their business model. They also have new product growth with chronic disease management, which accounts for 60% of adults in the US, with $3 trillion in US spend, that 50 billion of which was netted by Aetna. We also have home hemodialysis that they want to break into with 114 billion in Medicare spend. And we have a consumer value of a focus on storefront, app, and home value for consumers. We also see that Medicare Advantage enrollment has been growing quite frequently over the past few years, especially in picking up after their purchase. So moving to the valuation and share performance, we see that the price to earnings and the enterprise value to EBITDA are not great, but we expect those to lower going into the future as some of that debt is paid off. Looking at the cash total debt, we see that it's significantly leveraged right now. Debt to enterprise value is at 49%, but the company has good plans to reduce that, and we'll talk about that in the future. Just breezing over the key performances, we do want to mention that the US population is within 10 miles of the CVS, 85%. And also the company has a strong consecutive quarter of dividends paid at 89. Let's move on. Sorry, there we go. So the business model, breaking it down, we have healthcare benefits. That's solely Aetna with 8.7% growth. We have Medicare Advantage being the primary driver, and commercial health coverage expected to pick up in the future. That makes up about 25% of CVS's revenue. And then we have retail and long-term care, which is at 5.3% growth. Not great, but they expect this to grow into the future. They're trying to place care, consumer care, in minute clinics, health hubs, and apps, which would reduce the amount of time that it would take for somebody to get quick diagnostic care. And they also expect to pick up quick prescription deliveries, and that makes up about 30% of the market right now. Then we have pharmacy services, which hasn't grown very much, but makes up 46% of the company. And that's where retail, mail order, and specialty is all put into. So some of the competitors that we see, Magellan, Cigna, Humana being some of the three biggest, but I think that PillPack is expected to pick up too. That's the subsidiary of Amazon Pharmacy, which is a pretty newcomer to the market. Then we have Covetrus and Anthem Blue Cross as some other competitors that hold up. Looking at our comparative market analysis, including those companies, I'd like to focus on the last four, where we have working capital turnover, which is higher than the market. That's letting me know that management is doing well with the capital that they have. We also have return on equity and return on invested capital much higher than the market, which is showing that we're getting a lot of value as the investors. And at the time that I did this market analysis, the PEG ratio was lower than market, which is letting me know that this company was at a good price to buy. Some of the strengths that the company has are consistent shareholder value, a diverse product range, and that 85% of the US market accessibility. But some of the weaknesses include that they're only focused in the US. There's a lot of reimbursement pressures from other companies. And then we also have a high debt to equity ratio that could affect the company quarterly. Some of the opportunities include a growing Medicare Advantage market in the US, also the utilization of AI to decrease their cost, and a major disease service emphasis. But the threats to that are primarily from Amazon with their strong mail order competition, We also have drug pricing wars between the companies and the imitable business model that kind of lets these companies fight together. So breezing over the ESGs, we have some of the positive efforts that the company is doing, reducing their environmental impact, focusing their COVID response to this past year and into this year. And then also the fact that Karen Lynch became CEO in February. Karen Lynch has a great track record within the insurance industry. And she also brings a lot of value to the company as well in that sense, because that's where the company is growing the most. Okay, so going over the investment thesis, we see frequent overperformance with earnings per share expected to go into double-digit growth in the next few years. We'll talk about that in just a minute. We also see that the Medicare Advantage penetration rate for the market is really high at over 40%, and we expect that to pick up for Aetna as well. We also have operations efficiency, where the company is hoping to save $2 billion each forward year after 2022. And they also expect some more operations in 2021 to decrease by 900 million. And that'll be a good indicator to see if they're on track. We also have a strong repayment plan where they've focused 25% of their capital deployment on the shareholders, but they've also placed a strong emphasis on that debt pay down. They have good plans for their capital expenditures and also a 10% buffer for any additional needs. So why hold? They have strong fiscal year strategy, but they have volatile quarters, and right now they're pretty much at the price evaluation. So we don't want to go in when the getting's good, or when the getting's not good, I mean. Okay, so some of the assumptions that I'm basing my thesis off of are, if you look at the fiscal years for 2019 and 18, they've been around 4% generally. 19 was a good year for them, but that's accounting for when Aetna was introduced to their balance sheet. So I think that they're expecting to stay around that 4% growth range. We also expect their net working capital turnover to increase as time goes on and that debt is repaid. We also see that the leverage ratio has been decreasing over time. In 2019, it was 4.7, and the company said that they wanted to bring it down to 3.5, which they did in 2020. And they also expected to bring it down to 3.2 by 2021. And so we're hoping to get that leverage ratio to a good rate at about 3 by 2022. So moving into the risks, some of the liquidity concerns. We have the debt and revenue decisions that are going to be critical to maintaining their shareholders' trust, and they have sensitive market responses. We can see that in 2018 to 2020, they increased their payments significantly, which is great. It shows us they're on track and they understand that they need to pay this off well, but the market doesn't respond very well to that quarterly. We also have drug price hikes, which are pretty continuous. That's going to be a risk every single year. They rise year over year, and that increases despite economic hardships. We also have reimbursement pressures, which is the drops basically attributed to their drops in net income. And typically when they try to fight reimbursement pressures, which usually increase at almost 4%, the appellation typically fails in courts. We also have the mail order retail shift, where 38% of e-commerce is growing. We also have those disadvantages from Amazon Pharmacy and the fact that they're trying to cut drug prices by about 40%, which will end up hurting the entire market. But we have really strong catalysts. Vaccines this year totaled 240 million, and that was just in 2021. We expect that to really pick up to their top line. We also have adult flu expected to pick up, and those vaccines are expected to grow at about 46% by the end of the year. Medicare Advantage also picked up by 16.5%, and that's the star product for Aetna as their government business. So that's really exciting news. The health insurers fee was repealed, basically taking off the fee for their commercial benefits program. So we expect to see growth there as well. And that also helps out their consumers. And to finish that off with a consumer focus, we see that the company banned tobacco products back in 2015. And now we're seeing the positive impact where 38% of CVS cigarette shoppers say that they're willing to quit now. So in summary, I say we hold on CVS, wait for stronger upside, and try to bring a conservative portfolio value. I'm confident in the evaluation because we have mild assumptions and achievable benchmarks for the company to meet. We also have manageable risk, and if the company is able to upsize their profits in mail order segments, I think they stand a pretty good chance in the market. And those powerful catalysts with primary investment growth from Aetna and some of the COVID and flu macro tailwinds. All right, and that's my presentation. Thank you, guys.
All right, yeah, once again, great presentation. I noticed that you added some more graphics and some more graphs to really like make the data more visualized. So great job on that. Does anyone have any questions?
So when you said with their, you're talking about their dividends, right? What's a dangerous level for dividends that you would say, like in terms of the payout ratio? Because you said, I don't want to see it go double digits. Did you look at the payout ratio or anything like that when you're looking at the company's dividends?
I didn't look specifically at the payout ratio, but I was looking at their current ratio, and I think that their debt to equity is pretty even for the market. I could actually pull this back up if you want, or I could just tell you. Basically, CVS is at 2.31. The market is at 2.27. The companies typically have a high debt to equity ratio, but I don't like the fact that they're increasing their dividends while they have high debt. I would prefer them to see this debt paid off before they start increasing dividends, because to me, it seems like kind of a cash grab, which, you take it as it is. They kind of need a lot of the capital to be able to pay off the debt, but I would prefer if that was coming from their segments and not from shareholders.
All right. Thank you.
So I think Jacob has a question.
Yeah, so Cam, once again, great presentation. I think everybody can see you really put a lot of work into this. So you're saying you used to have a buy, now you have a hold. So now that you have this hold, what kind of % return are you expecting for a long-term investor, since you're still confident that this company can achieve some semblance of growth? Do you have any idea of what you're expecting the company to return in terms of whether it's revenue growth or free cash flow yield or something like that? What would you say you use to determine that?
Yeah, so I typically expect their net income to increase by about 5%. That's what we've seen in previous years. And I'm hoping that that's what they carry through in the future. Obviously, it's offset by certain characteristics. I think that a hold is probably the best option, because when we're looking at the competitors, there's a lot of danger, I think, to the fact that Amazon has, well, maybe not a strong hold right now, but it could be a strong hold. So I think that if we're looking at overall return, 5% is probably pretty close. When I was looking to like a week ago, I had about 6% upside compared to the 12%. I thought it was extremely undervalued a couple months ago when it was at like 60, and there was an upside of about 20%. So I think 6% is probably where that lies. Obviously, I can't be too sure, but I think if they met their benchmarks, then we might be looking around there. Definitely conservative. It's a big company. I don't expect it to be, massive return over time.
Yeah, no, definitely. And I think, like you said, around 6% growth plus, 2 to 3 GDP growth will get you around a return of 8 to 9%, I think, for long-term holders. And kind of a follow-up question to that was that why are you so about their debt and them increasing their dividend payout? You see how much free cash flow these guys generate? It's insane. Do you really see them kind of using some of that cash flow to pay back shareholders? Like you're saying, they're trying to create shareholder value at the same time. Is the debt really that big of an issue to you if they're a huge cash flow generator?
Considering the fact that if we look at, I know I'm not sharing, so maybe that's not the best way to say it, but their cash to debt right now, cash is about 10 billion, maybe almost 11. Total debt is 85. To me, that's extremely high ratio. But like you said, I think they do have a great way of paying it off right now. And from what I've looked at, and I had a few graphs that I unfortunately had to take off of this, they've been paying it back in massive amounts the past couple of quarters. And that to me shows that they have a great way of managing it. They usually set aside, I think they set aside 4 to 6 billion per year the past couple of years. And it seems like that's their plan right now. They've also been good about paying off the debt over time. So they spread out the payments over future years, where most current years they spend most of the money, but they've also tried to like create that future debt repayment too, so they're not affected by really big payments later on. So yeah, long run, I think they have a really good strategy. I don't think it's a huge concern, but I think that quarterly is really the long run thing that bothers me, is that like when they do those massive debt repayments, it's usually one at a time and not over time, because obviously they're trying to be strong at the beginning of the year, gain the shareholders' trust, and then all of a sudden towards the end of the year they just dump in tons of their cash into the debt. And I don't think that creates a lot of value when you see your stock just suddenly decline by a huge percentage, unless you're really confident that they're doing well. So I personally am confident. I think that they have a good plan for it.
Yeah, thank you. I think that answers the question. Any more questions from?
Yes, we have like 3 more minutes, so we'll go Damien and then Andrew.
Okay, I'll make it quick. Like everyone else, it was great. Struggled to even find a question really. So I'm kind of piggybacking off a bit of Jacob's and touching on the competitors again.
Okay.
We're obviously aware that e-commerce competitors like Amazon might, cut into market share. Are you aware of how CVS is positioning themselves to kind of defend off those attacks?
Yeah. So Amazon has this app that essentially it basically like makes it so that people who are filtered in from Aetna, right? You have that 39 million consumer base filtering into their app. And what they want is for people to buy their pharmacy needs straight from the app so that it can be home delivered to them. And what they've done is they've integrated some of their retail into the app. So we've seen a lot of people purchasing where they bundle the package together. They'll put their pharmacy needs and their retail needs together. I think that's a really great plan. I think that if somebody were to go specifically to buy there, and it was like shopping, say at a CVS, in a regular storefront, if you had to go and purchase stuff online, typically you might go to Amazon to see what you want to shop for as far as your pharmaceutical needs go. I think that they have a great way of creating that experience, but mobile. And I think that competes with Amazon, but the fact that Amazon has so much more people under their program already, it's tough competition for sure. But the fact that they're using the government contracts, I think, is the primary driver. That Aetna growth is what filters into the growth for the rest of CVS now. And I think that's why they're so confident in their decisions.
All right, great answer.
Cool. Andrew?
I'll quickly squeeze this in. It shouldn't be a big question. It's just on your competitive positioning slide, I saw you define the market in comparison to CVS. I just wanted to ask how you define the market in this case.
The market is primarily composed of pharmacy benefit managers. You notice that I don't include people like Walgreens or Rite Aid. I don't really see storefront retail as the future competition for CVS. I see especially like this online shift as the true competitors. And I think that these people, specifically the ones who are pricing against CVS right now, are really creating the real value for consumers. So I don't think anybody looks at something like Amazon and something like Rite Aid and compares them. Like, it's just easier to do Amazon. And especially when Amazon says that they want to create those discounts, I see a lot of value in companies that are forward thinking like that.
Okay, right on.
All right, judges. Great Q&A session. So Kyle, if you are ready, we'll just shift gears and go to the next one. But yeah, great job answering those questions, Cam. And great
Yeah, I'm gonna give a round of applause to Cameron. That was a phenomenal job. Kyle, step to the plate, my friend.
Yeah, definitely. No, that was great, Cameron. Let me share my screen.
Yes. All right. So once again, feel free to start whenever you're ready.
All right, guys. Hi, everyone. My name is Kyle Edwards, and I want to thank you for being here and to the Student Managed Investment Club eBoard for allowing me the opportunity to share my equity research on JP Morgan Chase. Okay, let's get started. JP Morgan Chase is one of the top 6 largest bank holding companies in the world and the largest in the US. If you take your attention to this chart presented on the screen, you can see that overall, JP Morgan's operations are divided into 4 main business segments. On the left side, under consumer businesses, we have consumer and community banking, which comprises more than 45% of the firm's revenue. On the right side of the chart, you see JP Morgan's remaining 3 segments, which fall under the wholesale business category, including corporate and investment banking comprising more than 30% of total revenue, asset and wealth management, which supplies more than 10%, and commercial banking that makes up less than 10% of revenue. With all 4 of these business segments, it's notable to see that 60% of the firm's revenue comes from interest income. Below the chart, I've noted a few key facts about JP Morgan Chase, and the firm can trace its history back to 1799 when it was named the Bank of Manhattan Company. On the bottom right, you can see that the market cap of this firm is currently $466.37 billion. Over 52 weeks, the firm is at a high share price of $161.69 and a low of $82.40. There has been a steady growing trend of earnings per share over the past 5 years, and understandably a small dip in 2020, but the firm is set to recover with a record-setting earnings per share estimate in 2021. Dividends per share growth has followed suit with strong growth in dividends per share over the past 10 years. Moving on to the next slide, we can see a snapshot of JP Morgan's financial highlights in 2020. On the left side, these bullet points concern specifically Q4 of 2020, where the company realized a net income of $12.1 billion and earnings per share of $3.79. The firm had managed revenue of $30.2 billion and expenses of $16 billion. When taking a look at the company's balance sheet for the Q4, it's notable to see that average loans of $996 billion were up 1% year over year, and similarly 1% when compared to Q3. On average, deposits were up 35% year over year and 6% quarter over quarter, resulting in a $2.1 trillion for Q4. Taking our attention to the chart on the right side, we can compare the financial results of 2019 and 2020. Net interest income decreased 4.8% to $55 billion in 2020, while non-interest revenue increased 11.9%. An increase in expenses and credit losses contributed to a decrease in net income and earnings per share over the year. Now moving on to the outlook for 2021. We can see analysts are forecasting a recovery of net interest income of nearly 1%, which if you recall is 60% of JP Morgan's revenue on average, so this is good news for the firm. The left side of the screen shows more highlights in the 2021 outlook for JP Morgan, including an enormous share buyback program of $30 billion throughout 2021. I believe this is one of the most important factors pointing out JP Morgan's financial health and demonstrates the firm's strong financial expectations moving forward. In regards to dividends per share, Bloomberg analysts are projecting a 2.2% increase in 2021. Analysts predict a large 20.37% increase in earnings per share for JP Morgan to $12.82 in 2021. Transitioning to industry analysis, this slide shows a number of financial ratios that compare JP Morgan to its peers in the banking industry. Under valuation in the top left, we can see that the trailing 12-month price to earnings ratio and 5-year average PE ratios are below industry averages, showing JP Morgan is fairly priced compared to its earnings. Under growth in the bottom left, it's notable that over the past 5 years, JP Morgan has experienced higher than average earnings per share growth and revenue growth compared to peers. Moving to the top right under profit margins, we can see that JP Morgan's profit margin is higher than average in the end of 2020. Under returns in the bottom right, every metric given shows that the firm performs better than peers, most notably return on equity and return on assets. Continuing with industry analysis, this slide shows JP Morgan in blue compared to two main competitors, Bank of America in red and Citigroup in green. Comparing their margins over the past 5 years, we can see that JP Morgan has stayed the most consistent. And when looking at the dip in margins in 2019 to 2020, JP Morgan was able to outperform industry peers and experience less of a decline overall. Taking a moment to look at the investments set forth by JP Morgan in 2021, the budget for non-technology investments increased $1.5 billion. The purple box in the top right represents a $30 billion commitment to Path Forward initiative to fight racial inequality. Also included here is an acquisition of CX Loyalty, which is a customer engagement software program. The light blue box represents an increase in front office hiring of bankers and advisors, and also the firm's commitment to market expansion. The green box shows the firm's return to normal marketing budget after a slight decrease in 2020. The budget for technology initiatives increased $0.9 billion as the firm implements the CX Loyalty program and continues to invest in artificial intelligence, data analytics, and cybersecurity. Here we have the Band 13 developed by the Student Managed Investment Fund, which is a set of metrics that help further analyze a company after doing the initial screen and equity research. I'll highlight on the green scores on the right side, starting with EPS growth compounded annual growth rate from 2019 to 2022, increasing 2.49%. According to Yahoo Finance, the current year and next year forecast EPS trend is up over 90 days. The operating income was improving from 2016 to 2019, according to the Bloomberg database. Out of 29 Bloomberg analysts, 19 rated JP Morgan a buy, 7 rated the firm a hold, and 3 rated the firm a sell. The Piotrowski F score was a 4, and we'll highlight more about that on the next slide. And according to Yahoo Finance, the ISS governance quality score was also a 4, which is a solid number for this industry. Lastly, the average daily liquidity was close to 15 million trades, which is far over the minimum 50,000 needed. All other metrics in this BAM 13 were a fail, resulting in a score of a 7. As mentioned before, the Piotrowski F score for JP Morgan was a 4, and I want to highlight positive net income in 2021 and a higher asset turnover ratio than the year before. Even though we're used to seeing higher Piotrowski F scores in most cases, a 4 is typical for a stable company in this situation during the pandemic. As you can see, the bullet in the bottom right, the median over the past 13 years was a 5, which is not far off from the current value. Now we want to take a look at the two main risks I see for JP Morgan. One risk affecting JP Morgan in the long term includes the increased regulations of derivatives trading, which could potentially translate to the trading revenues of JP Morgan being negatively impacted. Understandably, another issue for JP Morgan is the fact that until COVID-19 cases completely flatten, this will continue to pose risks such as muted loan growth in the short term and the firm's competitors as well. However, JP Morgan has had strong response to the crisis compared to its peers by improving cost efficiency through increased digitization of operations. Now we move on to the main positive drivers for JP Morgan. The company experienced strong revenue growth compared to its peers throughout 2020 and especially in the fourth quarter. Over the past 5 years, the firm has had steady earnings per share growth and dividends per share growth. They have increased efficiency as a result of digitization through mobile payments, investments in artificial intelligence, and working remotely. The net margin for JP Morgan has been higher on average than industry peers over the past 5 years. The firm showed higher earnings on their 10K report than were previously estimated by analysts, which shows JP Morgan's ability to exceed expectations. Most notably, in my opinion, JP Morgan announced a share buyback program of $30 billion throughout 2021. And this demonstrates their strong financial expectations moving forward. My valuation of JP Morgan is $182.05 per share using an excess return analysis developed by Professor Aswath Damodran with a 5% net income terminal growth rate and a 7.26 cost of equity for stable growth. Using a dividend growth model, the intrinsic value of JP Morgan is calculated at $186.23, while Wall Street analyst price targets for JPM are $165 on average. There are plenty of price targets well above the current trading price of $153 that support this higher valuation. Taking these drivers into consideration, the high valuation above the current trading price, and the fact that even in the post-COVID economy, this firm is well fit to continue outperforming its peers, my recommendation is a strong buy for JP Morgan.
All right,
Very good
Kyle.
presentation.
Yeah, another great presentation. You can see that it was pretty thorough. So I'll get started with the first question here, and that was obviously under 10 minutes. So thank you for that. Yeah, a strong buy. You can see that by your valuation. Like you said, you noted that it is above average, which I'm seeing as well. Can you talk to us about the reason for using the residual income model over a DCF model? And did you try to use a DCF model? And I'm asking that because obviously your valuation is a little bit higher than the average, and there's nothing wrong with that. But would that have to do with your different valuation model that you use? So kind of like why you picked that.
So at first, when I tried doing the regular DCF model, I was noticing there's a problem when you're inputting the interest as an expense, because really that's a revenue for a bank in this position. And so as far as going through that, I just chose to do two models that I saw fit. And I knew that the excess equity return model developed by the Modron was a good solution. It's really similar to a discounted cash flow model. The only difference is you're using excess equity returns, which is return on equity minus the cost of equity multiplied by the equity capital invested, and you're discounting those instead of free cash flow. So it was a similar method. It was just using something different at the end to discount it. But I did use the dividend growth model as well, and it actually had a higher valuation than the excess return. So I was really trusting those valuations. And I know that on Bloomberg, I see some analysts going as far as 190. And I just know that, you know, if I had a higher valuation, it really could just be pointing toward that strong buy. So
Yeah, no, thank you for that. So we'll go with Damien for our next question.
All right, so once again, really great presentation. I actually wanted to learn a little bit more about the banks recently, so it's great to learn about JPM. I actually looked at their Q1 report, along with like Goldman and some of them, and they all had real blowout quarters, right? And so I'm wondering what you think about their longevity and kind of like on a quarterly basis. Like, do you expect them to have such phenomenal, mainly in their assets trading and management sector? Do you expect them to have such a high return, or kind of spread out and return to maybe like 2019 levels after this volatility kind of decreases and things like that?
I would say that Q1 for JP Morgan was definitely very strong. They had a strong increase in assets. They actually went over 3 trillion for the first time. So that was a really great first quarter for them. And I would say as the economy continues to open up, their actual revenue is just going to continue to increase. I'm kind of going to the interest rate conversation. I know the Fed is keeping interest rates low right now, and that is muting loan growth for them and also like their total revenue. So if the economy starts to open up and more people start to take out loans over the course of 2021, it really would just kind of amplify that growth for JP Morgan.
Definitely. Yeah, the volatility in the stock market might kind of be muted by the interest rates and all that. Yeah, definitely. Like it. Go for it, Andrew. I think you're next.
Yeah, another great presentation. I love that you guys are making that mini IRC look great. So I have two questions, but I'll only ask one for now. First of all, you said one of the biggest drivers in your valuation, well, why you had a really awesome tailwind for JP Morgan was the share buyback program. Can you talk a little bit more about that?
Yeah, so basically when the company is going and putting so much money back in and basically putting more money back to their shareholders, it's really, to me, it shows that they're confident in their own company. And it's kind of like another way of paying out a dividend to their shareholders. They're really returning money back to them. And kind of going along with that, like the share buyback program definitely demonstrates their confidence, and they're also expanding into new branches and well. And it's really like all throughout 2021, I believe they're expected to do 400 new branches or just actual front offices where people can walk in and kind of start their accounts. So that's definitely just another way to demonstrate that they're kind of investing back in the company. So with that $30 billion share buyback program, it really just shows the confidence in the management of their own company. That's kind of what was the main motivator for that.
Was that the Path Forward initiative?
So those are actually similar numbers. The
That's
30,
right. Okay.
Yeah, so the 30 billion, it was more kind of within their company and also outside too. That's more about just kind of, I know that the chairman, he's actually very open about talking about racial inequality, and he's putting those $30 billion to fight that and really make kind of the firm itself, all the advisors really doing promotions and things like that for minorities. That's really what the Path Forward initiative is.
Okay. All right. That was kind of my second question. So thank you. Thank you.
So I think, Damien, did you have another question? Or if not, we'll go
No,
to
I just-
Damien.
Yeah, I was up from the last time. So go
Okay.
ahead, Jacob.
All right, Kyle, thank you so much for taking the time to do this. I really appreciate it, and great presentation. So I guess got two things that I guess I'd like to discuss. One is I have this great buy report from you and a strong presentation about why I should buy, and yet I have nothing about who's managing the company. I know you know who that is, but I would like to see that in the presentation, because to me, you're talking about JP Morgan and it's the head is Jamie Dimon, you know, so I think having that, especially for people who don't know who that is, you know, having that guy as your CEO is very cool. I mean, he's one of the smartest leaders right now in, I would say, just in business in general. So could you talk, I guess that's my first question, is could you talk a little bit about what his vision for the firm is and why does that support your strong buy?
So Jamie Dimon, he actually is a very strong leader for this firm. He's been there since 2005 as CEO for JP Morgan. So you can show the longevity of just his station at the firm. And really, you know, he's also has a strong track record before that. He was actually one of the board of directors for the Federal Reserve. So he does definitely have a lot of just behind him in general. But he actually did a letter to the public recently that shows that he's bullish on the economy in general. So he's confident that as we come out of the pandemic, that spending is going to increase, and that's also going to kind of piggyback on that increased revenue through increased loans being taken out by consumers. So those go hand in hand. He really is projecting a good year for 2020 on 2021, I believe. And so that would basically just go hand in hand. He's bullish on the US economy, which is also bullish on his own firm as people are more confident.
Great, thank you for that. I guess my second part here is we have, you said something like 19 analysts with a buy recommendation. This is both CVS and JP Morgan are obviously, you know, well-watched stocks by many analysts. So what is your kind of unique perspective as to why this is a buy? And if it's so undervalued and yet so many people are watching the company, you know, what's that reason for the difference in value from you're getting from your return models and then from what the current price is?
Yeah, honestly, I feel like it is undervalued, and I feel like people aren't seeing the potential that would come out as far as comparing to competitors. I feel like that's a big part of it, is that they had a really good 2020 during the pandemic. They didn't have too much of a decline in margins compared to competitors. And also, they've been able to increase the assets. I know I mentioned that before. But just in general, I would say JP Morgan, it's set to increase throughout 2021. And yeah, I have a dividend growth model. That one was a very high valuation at first, 186, and my other one was 182. But I did see, I kind of mentioned this before, but on Bloomberg, there are some analysts projecting over 190 for the valuation. And I didn't want to kind of discount the fact that some people are as optimistic as I was on that. And so I thought 180 to 186 was a good valuation on it.
Okay, thank you. So I'm just gonna take, so your kind of unique point is just that JP Morgan's kind of better than the rest, you know, and not many people are seeing that. Is that kind of what I'm getting in terms of competitors? They're gonna be better than their competitors. They're gonna grow stronger.
They're going to grow stronger. They're also very diversified across a lot of different sectors within the banking industry, while others might not be. And that's part of the reason why throughout 2020, they didn't get hit as much. They have a large mortgage sector as well as their investment banking. So they're, you know, while some people were not taking out as many loans in general, they were able to capitalize on the fact that there were low mortgage rates and people were more enticed to go and buy homes during the pandemic. So that was one thing that kind of helped them offset the muted loan growth that came from businesses. So their diversity is definitely a strong factor for JP Morgan. And also mentioned before, they're just looking to expand throughout 2021 with 400 new branches. So just that strong outlook as well is one of the another factor. I know that wasn't on the slides, but they are expecting.
Yeah, great point to mention. Thank you, Kyle. So I don't want to take time from the other judges, but thank you.
Yeah, thanks, Kyle and Jacob. We might have time for like one quick question, either Andrew or Damon. Like,
No, you kind of answered my question anyway with that last one. So if we have to move on, definitely okay.
One, it could be quick. I love the Smith plug, BAM 13, real cool. But I saw revenues declining. Yes, super strong buy. Why is revenue declining over the next couple of years? You have negative 5 point some odd percent.
So as the interest rates are expected to be kept low by the Fed, that isn't projected to increase too soon into the future. And I know that was a growth rate to 2022. So if that does change and the Fed does just come out of basically what they've been saying before and start to rise rates significantly, their revenue from net interest income will definitely follow suit with that. So I believe that Bloomberg analysts, because that's how I basically did that compounded annual growth rate, was using the Bloomberg numbers for revenue in 2022. And so if that does change and their net interest income is set to increase, then that number will definitely change out. So this buy recommendation is really based off the fact that if you're looking to go into a diversified bank, this is one of the best out of all the competitors. If you're looking to put a bank into your portfolio, this is definitely a strong buy. And I know that, you know, in different situations, I know like Professor Tom Correa, he's looking for a couple banks in Smith portfolio. This would be definitely one of those that would fit that. But as far as just in general, yeah, I do see that as kind of a downside, the fact that analysts are projecting revenue growth to decrease, but that does just, it comes hand in hand with their interest income.
Sure. All right. Thanks, Kyle. This is great. And to both gentlemen, phenomenal job. Both you guys. That was amazing.
all right. Yes. Can we get some round of applause in the chat? Excellent presentations. I think the Smith program gets better because of the research that we do and the equity analysts that we have. So with that, that's all we have for today. The judges will deliberate today and tomorrow, and we'll have an announcement by Thursday. And then once again, first and second place will get a cash prize, but first we'll take home the bigger cut. So thanks again to our competitors and our friends and our SMIC members. We really appreciate it.